Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Jennifer Schnabl, Vice President of the ETF Capital Markets Group at State Street Global Advisors, to discuss how the bond landscape is evolving and how to position your portfolio in the uncertain economic backdrop. Jennifer, it's great to see you. Welcome back to Trade Talks.
Thanks, Jill.
We've had a significant amount of volatility in the markets in the first quarter of this year. How has the landscape for bonds evolved, and how should investors consider positioning their bond portfolios?
Right, Jill, thanks so much. It's been a challenging start to the year. The first quarter for investors we had, as you know, a sharp risk rally in January, and then a reversal of that in February, and then March saw a tremendous amount of stress in the regional banking sector and concerns over financial stability. So while both equities and fixed income are up for the year, the path from the beginning of the year till now has certainly been anything but straightforward, and investors are concerned, can remain concerned for the remainder of 2023. Their concerns largely are around interest rate volatility, the uncertain path for interest rates going forward, and the increasing credit tightening conditions, I would say. So where does this, against this backdrop, where does this leave investors, and how are they positioning their portfolio, like you said? The most dominant theme we've been seeing thus far, and I think it continues, is a flight to safety and a pouring of assets into government bond funds, namely the ultra short duration suite, so T-bills, to be more clear about it. So our 0 to 3 month T-bill ETF, BIL, it has about $28 billion in assets today. It's gathered over $14 billion of assets in the last 12 months, so basically doubled in size, just to give you a sense of that investor sentiment. And we've also found in our investor conversations, it can also double as a really great place to park your cash. If you're concerned, you maybe don't have such a convicted view right now and you want to wait for a clearer picture, you can put your money there, and this vehicle earns over 4%, given where interest rates are right now, and takes on very little, or some would say no, duration risk.
So when you think about the fixed income asset class more broadly, is it just a game of playing it safe?
Great question, Jill. Yes and no. I think that the preference still remains in the higher quality areas of fixed income. So if you're going to venture outside of T-bills, sticking to high quality, so investment grade corporates is seemingly very popular, still on the shorter duration side, so maybe 1 to 3 year investment grade corporates we're seeing a lot of interest in. And that remains high quality, so it's less concerning to investors who are potentially worried about default risk. Now, for those that might have a bit more of a view on the path of interest rates, we're also seeing interest in extending the government treasury sort of expression, but further out the curve. So our 3 to 10 year treasury ETF, SPTI, has gathered a good amount of assets, almost $2 billion in the first quarter of this year, just showing some more conviction on the part of investors, to the extent that they think that the Fed will pivot, pause, or start cutting sooner than the market is pricing in. And I'll just say, I think it's a good time when markets feel uncertain and investors are on edge to just remind ourselves of the role that bonds were originally meant to play in investors' portfolio. We're seeing that being mentioned quite a bit in our conversations as well. The first is, it's a diversification tool, offset against equities. Second is capital preservation, and the third is income generation. And these things still largely hold true, and extending your duration a little bit out the curve, like we just spoke about, it can provide a ballast to your portfolio should we enter a downturn or we see rates fall.
I mean, the growth that you mentioned in the ultra short, doubling in just a year is really quite impressive. What other trends are you monitoring as it relates to investor preference and positioning?
Right. Well, in the larger, I would say, fixed income ETF landscape, we're seeing a tremendous amount of growth and interest in the active space. So investors leaning into the actively managed fixed income ETF world, especially in times in the times we're in right now with some uncertainty on the forward picture. We just launched about a year ago now one of our flagship credit ETF fund, HYBL. This fund is actively managed by Blackstone, obviously one of the largest loan and credit managers in the world. They've seen a tremendous amount of success in their prior loan ETF as well. this fund has half high yield and half loans and a little bit of CLOs. And what this does is, for those investors who don't have the wherewithal or perhaps the resources to navigate these securities or these asset classes on their own, and given the dynamic environment that we are in right now, also maybe don't feel equipped to pivot and take advantage of opportunistic moments, we're seeing them lean into handing the reins over to best-in-class managers who can help navigate those murky waters for them and earn something beyond the investment grade, high-quality area, but in a way that maybe feels a little bit more prudent or more professional given where they're at.
Yeah, well, that's a great thing about the ETF product.
Exactly.
Right? It makes it so much more efficient for investors. Jennifer, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.